As parents, we strive to provide the best for our children. We want them to have every opportunity to succeed. This includes financial security. It's important to understand how taxes can impact their finances. One such tax is the kiddie tax. Don't let the name fool you. This tax can have real implications for families. Navigating the world of taxes can feel daunting, but understanding the kiddie tax is crucial. We'll break down the complexities of the kiddie tax. Let's dive in and demystify the world of kiddie tax. The kiddie tax might seem like a modern invention, but it actually has roots going back to the 1980s. Back then, some wealthy families were using a clever tactic. They were shifting their investments into their children's names. Why? Because children typically paid lower tax rates than adults. This strategy allowed these families to reduce their overall tax burden. To address this issue, Congress introduced the kiddie tax in 1986. The goal was to prevent parents from dodging taxes. The kiddie tax has evolved over the years, but its core purpose remains the same: to prevent tax avoidance. Before we delve into the specifics of the kiddie tax, let's define a key term: unearned income. Unearned income is money earned from sources other than employment. This includes things like interest from savings accounts and dividends from stocks. It also covers capital gains from selling investments and income from trusts or estates. The kiddie tax specifically targets unearned income. It aims to prevent parents from sheltering their investment income. They do this by putting it in their children's names. Understanding the difference between earned and unearned income is crucial. In the next section, we'll explore the mechanics of the kiddie tax. The kiddie tax is a set of tax rules. They apply to children who have unearned income above a certain threshold. This tax was created to prevent parents from avoiding higher tax brackets. Instead of taxing a child's unearned income at their own tax rate, the kiddie tax uses the parent's tax rate. This generally means that the child's income is taxed at a higher rate than it would be otherwise. However, there is a certain amount of unearned income a child can receive without triggering the kiddie tax. This is known as the standard deduction amount, and it changes yearly. It does not apply to a child's earned income, such as wages from a part-time job. Understanding these basics is crucial to comprehending the kiddie tax and its implications. The kiddie tax applies to children under the age of 19. It also applies to full-time students who are under the age of 24 and financially dependent on their parents. There are some exceptions to these age limits, such as for children who are permanently disabled. The income threshold for the kiddie tax changes annually. As of 2023, a child's unearned income is generally subject to the kiddie tax if it exceeds $2,400. The first $1,200 of unearned income is typically tax-free, and the next $1,200 is taxed at the child's rate. Any unearned income above $2,400 is taxed at the parent's rate. Understanding the age and income thresholds for the kiddie tax is crucial for determining if it applies to your family. If you think your child might be subject to these rules, it's essential to consult with a tax advisor. Let's say your 10-year-old daughter receives $5,000 in dividends from stocks held in her name. Remember, the 2023 threshold for unearned income subject to the kiddie tax is $2,400. The first $1,200 is tax-free. The next $1,200 is taxed at her rate. The remaining $2,600 would be taxed at your tax rate. In another scenario, imagine your 18-year-old son works part-time while in college. He earns $8,000 from his job and receives $3,000 in interest from a savings account. The $8,000 earned income is taxed at his rate. However, the $3,000 in interest, being unearned income and exceeding the $2,400 threshold, is partially subject to the kiddie tax. These examples illustrate how the kiddie tax can impact families with varying income levels and investment portfolios. Consulting with a tax professional is highly recommended. Let's talk about the most common types of unearned income, dividends, and interest. Imagine your child inherits a few shares of stock from a grandparent. Those stocks generate dividends. These payments are considered unearned income for your child. If the total dividends your child receives in a year exceed the kiddie tax threshold, the excess amount would be taxed at your rate. Similarly, interest earned on savings accounts, CDs, or bonds falls under the umbrella of unearned income. The interest earned on that account is subject to the kiddie tax if it goes beyond the annual limit. Understanding how dividends and interest factor into the kiddie tax equation can help you make informed decisions about your family's investments. The kiddie tax ensures that the tax burden on those earnings is distributed fairly. Another area where the kiddie tax comes into play is capital gains. These are the profits made from selling an asset, like a stock or a piece of real estate, for more than its purchase price. Let's say your teenager dabbles in the stock market using a custodial account you opened for them. If they sell a stock for a profit, that profit is considered a capital gain. If the total capital gains your child realizes during the year exceed the kiddie tax threshold, the excess amount would be taxed at your tax rate. Short-term gains from assets owned for less than a year are generally taxed as ordinary income. Long-term gains from assets held for more than a year may be eligible for lower tax rates. Understanding the nuances of capital gains taxation within the kiddie tax framework is essential. Unearned income subject to the kiddie tax can also come from sources like trust funds and guardianships. Trust funds, legal entities that hold assets for a beneficiary, often generate unearned income in the form of interest, dividends, or capital gains. If your child is the beneficiary of a trust, the income they receive from that trust could be subject to the kiddie tax. Similarly, if a court appoints you as a guardian managing assets for a minor, the income generated from those assets might also fall under the kiddie tax rules. These situations can be complex and require careful consideration. The tax implications can vary depending on the specific terms of the trust or guardianship. Navigating the intricacies of trust funds and guardianships in relation to the kiddie tax can be challenging. It's crucial to seek guidance from a qualified tax professional or estate planning attorney. We've talked about unearned income, but let's clarify who exactly the kiddie tax applies to. The rules primarily revolve around a child's age and dependency status. If your child is under 19 years old at the end of the tax year, they generally fall under the kiddie tax rules. This means their unearned income above the threshold will be subject to your tax rate. Now, even if your child is 19 or older, they might still be subject to the kiddie tax. This applies if they are full-time students, under 24 years old, and financially dependent on you. There are a few exceptions to these age guidelines. It's always a good idea to consult with a tax professional to determine if your child's specific circumstances align with any exceptions. The kiddie tax might sound a bit daunting, but there are ways to plan and manage it effectively. One strategy is to consider the timing of your child's investments. If possible, try to time the realization of capital gains for years when your child will be in a lower tax bracket, either after they turn 18 or once they are no longer considered your dependent. Another strategy is to invest in your child's name using tax-advantaged accounts, like 529 plans for education expenses or Coverdell education savings accounts. These accounts offer tax benefits that can help offset the impact of the kiddie tax. Contributions to these accounts grow tax-deferred, and withdrawals for qualified education expenses are tax-free. You can also explore investing in assets that generate long-term capital gains, which are taxed at lower rates than short-term gains. It's about making smart financial decisions that minimize your family's tax liability while maximizing your child's financial well-being. One of the most effective ways to mitigate the impact of the kiddie tax is to utilize tax-advantaged accounts specifically designed for education expenses. The most popular option is the 529 plan. These plans allow you to contribute after-tax dollars that grow tax-deferred. When you withdraw the funds for qualified education expenses, like tuition, fees, and even room and board, the withdrawals are completely tax-free at the federal level. Some states even offer additional tax benefits for using their state-sponsored 529 plans. Another option is the Coverdell Education Savings Account, which offers similar tax advantages but has lower contribution limits. By strategically using these accounts, you can potentially shelter a significant portion of your child's unearned income from the kiddie tax. This allows the funds to grow more efficiently for their future education. Navigating the intricacies of the kiddie tax can be complex, especially given the evolving tax laws and individual financial situations. While this guide provides a comprehensive overview, seeking guidance from a qualified tax professional is crucial for personalized advice. A tax advisor can help you understand the specific implications of the kiddie tax for your family. They can analyze your income level, investment portfolio, and future financial goals to develop a tailored strategy. They can also ensure you're taking advantage of all available deductions, credits, and tax-saving opportunities. A proactive approach to tax planning, combined with expert advice, can help you optimize your family's finances. It will also allow you to secure a bright financial future for your children. The kiddie tax often sparks debate. Some view it as a burden on families trying to build wealth for their children. However, it's essential to understand the rationale behind this tax. The kiddie tax ensures fairness in the tax system. It prevents wealthy individuals from using their children as tax shelters. By taxing a child's unearned income at the parent's rate, it levels the playing field. This helps fund essential public services like education and healthcare. The kiddie tax promotes a more equitable distribution of wealth. It fosters economic opportunity and social mobility for all. The kiddie tax plays a vital role in maintaining a just tax system. Section 2. Minimizing the impact strategies for tax optimization. While the kiddie tax aims to level the playing field, it doesn't mean you can't optimize your family's financial strategies to minimize its impact. As we discussed earlier, utilizing tax-advantaged accounts like 529 plans and covered ESAs is a smart move. These accounts provide tax-sheltered growth and tax-free withdrawals for education expenses, effectively mitigating the kiddie tax on those funds. Another strategy is to consider the timing of your child's investments. If possible, try to defer realizing capital gains until your child reaches the age when their unearned income is taxed at their own rate. This might involve holding on to investments longer or strategically planning sales to coincide with lower income years. Additionally, explore investing in assets that generate long-term capital gains, which are generally taxed at lower rates than short-term gains. Remember, tax optimization is about making informed decisions that align with your family's financial goals while minimizing your tax liability. Section 3. A future-forward approach, teaching kids about financial responsibility. The kiddie tax presents a valuable opportunity to teach your children about financial responsibility from an early age. While it might seem like a complex topic, explaining the basic concepts in age-appropriate terms can empower them to understand the importance of saving, investing, and managing their finances wisely. Start by explaining the difference between earning money through work and receiving income from investments. Talk about how taxes work and why it's important to pay them. You can even use practical examples like the kiddie tax itself to illustrate how financial decisions have tax implications. By involving your children in discussions about family finances, you not only demystify the world of money management, but also instill in them a sense of responsibility and ownership over their financial future. This early education can lay the foundation for sound financial habits that will benefit them throughout their lives. Section 1. Knowledge is power, embracing informed financial decisions. Understanding the kiddie tax is crucial for informed financial decisions. It ensures fairness and prevents tax avoidance. Manage its impact to optimize your family's financial strategies. Utilize tax-advantaged accounts and seek professional guidance. Knowledge is your most powerful tool. Navigate the tax code confidently and align with your long-term goals. Section 2. Your family's financial journey, planning for a secure future. As parents, we want the best for our children. We strive to provide them with a solid foundation for a happy, healthy, and financially secure future. Managing the kiddie tax is part of that puzzle. Take a holistic approach to your family's finances. Seek guidance from financial advisors and tax professionals. Engage in open conversations with your children about money. Create a legacy of financial well-being for your family.